Welcome to this week's Q&A. We've got a really good question this week from one of our viewers in Hong Kong, and he's an Aussie expat there, and he's bought a property that's in a sort of medium density building, so it takes over 2 years to complete, and he bought this property about a year ago. So his question is, look, I'm a bit concerned if I can get a loan when the building's completed in about another 15 months time, and I can understand that because it's something that many people think about because of the rapid rise in the overnight or in the official cash rate in Australia. The Reserve Bank has now lifted that to 4.35% as of the last meeting. So serviceability can become an issue for people, especially if they've had perhaps a change in circumstance where their income has decreased due to a change of employment or other reasons. So, we get these questions. This is a really good one. And the answer comes in many parts, I suppose, because of the long lead time, we're talking about another 15 months at least before this asset is able to be transferred, or the title is able to be transferred to the purchaser. I can't really predict with any degree of certainty where the official cash rate and therefore where mortgage rates may be in 15 to 18 months time. It's probably wise to think about it in relation to where they are now, and certainly most economists, most international banks, most domestic banks also think that interest rates will start coming down next year, 2024, at different times and to different varying degrees. So at the moment you have Morgan Stanley and UBS, for example, saying that the US, the Fed's going to cut rates by perhaps a lot more than the market's pricing in, and starting sooner, prior to mid-year 2024, as the American economy cools and perhaps goes into recession. So similar things in Australia. It's interesting that financial markets and bond markets tend not to be great predictors in relation to what occurs with future interest rates. But you could say it will mean that interest rates will be lower than they are now. By how much we can't really predict just yet, but it may be a considerable amount. So it's something worth keeping in mind. That means even though you may not be able to service a loan now, at that point in time, you may be able to service that loan. So what else can you do? What things are in your control? Because clearly central bank rate settings are not in our control as individuals. However, certain other things are, and that's what I want to say to this person asking the question. Make sure you got those things really right. So credit score is one that I've noticed the bank's looking at, and it can really impact a client's borrowing capability, if not serviceability. So it's something the banks will look at, and it's simple things like people missing payments on their credit cards, continually being late, perhaps other small bills that may seem totally insignificant to someone. They're not when it comes to credit scoring, and they can have a massive impact. So they can bring someone's credit score below 500 when they haven't had any great financial blow up, as it were. So really important to start looking at these things and making sure that you're fairly meticulous in your record keeping, and also then making sure those transactions occur on time, all your repayments occur on time. So look, if you found this of interest, subscribe to our YouTube channel and click like. And if you need some help yourself, or find yourself in a similar position, and please don't hesitate to reach out, email us or call us, and we'll have somebody call you or contact you and see how we might be able to assist you with your own personal set of circumstances. I'm Andrew Unterweger, and I'll see you at next week's Q&A.